All right. Good morning, everybody. Um, Actually, to be quite upfront and to be frank, I feel a little outside my comfort zone here. It's been a while since I've done a Facebook Live, and I kind of miss you guys, and I had a couple of thoughts I wanted to share, so I thought I'd just get them out there. So real quick, I am finishing up an amazing trip to see my sister, see my niece, my brother-in-law. My parents were here, kind of a little bit of all of it. So maybe heading back to the States in a few days there, which is really cool. But more importantly, I have had a ton of questions along these lines. And I'm sure this is on a lot of people's minds I want to talk about right now. Here it is, just as it sits. Will the real estate market crash? I'm going to give you three reasons why it will, but I'm also going to give you three reasons why it won't. Fair enough? All right, on with the show. So, Google put out a very, very interesting study a couple of weeks ago showing that the number of searches of people saying, when will the real estate market crash, has increased by over 2,400%, 2,450%. So this is on a lot of people's minds. Now, in the same token, Google also showed that the number of searches being done saying, how much above asking price should I bid on a home? I know that's a long search, but that's actually up over 350%. So people are very cognizant of where we're at with the real estate market. And I think that there might be a little bit of fear out there, but I also think it's a little bit of a fear of the unknown, right? I find in at least in my life, a lot of times when I get a little fearful of something, it's simply because I have a lack of information. So I'm hoping to give you guys and arm you guys just a little extra info, some tools you can use. And again, to make the best decisions for you and your family. So, three reasons why the market's going to crash, three reasons why it won't. Reason number one, interest rates. This will be the single greatest impactor to the real estate market as an outside force, is a substantial and fast raise in interest rates. Now, to this point, we haven't seen this happen. We've seen interest rates tick up a little bit, tick down a little bit, tick up a little bit, tick down a little bit. And I also think that we've learned some lessons from the 80s, the 90s, and frankly, the early 2000s on how to properly handle interest rates. And here's what I mean by that. So in the early 80s, we saw interest rates fly up rapidly, and they really crushed the real estate market hard. Right in the middle 90s, we saw some movement in interest rates up and down, and kind of what it did with the economy, both hurting it in the early 90s, helping it in the late 90s. Early 2000s, we saw interest rates just flatten, frankly, very quickly, pushing both the economy and the real estate market to a red hot heat. And then we had the crash. Right now, since the crash, we've been watching the Fed incrementally increase interest rates, not a ton at a time, but just a little at a time. Now, there's two ways the Feds can do this going forward. They can either really raise interest rates fast, and I'm talking like jumping by points every 6 months, because that could happen. However, the Fed is committed the other way, right? A slow and steady increase. We're going to keep rates low through 2022 to keep the economy on good footing and keep this red hot economic market going forward. But then I predict that we are going to start seeing those interest rates rise incrementally towards the end of this year, a little bit next year, definitely the year after, for sure, 100%. Will we see a 4 or a 5% interest rate in the next 72 months? Yes. Will it be in the next 6 months? No. That would put a dead stop on not only the real estate market, but our economy, just to be frank. So that's reason number one, it could crash. And also the reason number one, it probably won't. We've learned some really good lessons over the last 3 decades here economically on the impact of interest rates on not only real estate, but the general economy. The second, the inverted yield curve. So this is really interesting to me. This is something that I watch on not a daily basis, but on a monthly basis. But I watch where the bonds are paying, right? And I'm always watching for that inverted yield curve. Now, let's go over like what this actually is. So there are a couple of different bond markets that are regularly watched and kind of used as a benchmark. The 3 month, the 2 year, the 10 year, 30 year, like all of those bonds, right? Doesn't really matter which ones exactly, but here is a very simple definition of an inverted yield curve, where a shorter term bond actually pays more interest than a long term bond. Okay. I mean, I'm just going to keep that super simple because that's what it is, right? So typically speaking, a longer term bond should be paying a higher interest rate back to the person that's the bondholder. A shorter term bond will yield a much lower interest rate, right? Much lower interest. You'll make a lot less money. So if you're buying a 3 month bond or a 2 month bond or even a 2 year bond, and what you're making is exceeding by any amount, maybe a 10 or a 20-year bond, that's a problem. And that's what's called the inverted yield curve, right? We saw that happen briefly 2 times in 2020. And that caused me a little bit of apprehension, just to be honest, going into 2021 as to what was going to happen economically. Now, that said, watching everything else going on in the world with the coronavirus, the impact on the economy with that, how the government's been dealing with that, our bounce back in our jobless rate, right? So our unemployment rate keeps on coming down. I think that may be a fluke. Bear in mind, the last 7 times we saw an inverted yield curve, we also were headed for economic disaster on one level or another, right? And that either means that the stock market was crashing, unemployment was flying up, the housing market was crashing, something negative happened after that. This time, however, I think it is a flash in the pan, and here's why. So during the first quarter and up now, right, in 2021, so 2021 through now, we've been seeing the yield curve go the right way and start expanding, right? So we've seen the longer term bonds, the longer term treasury bonds, that what they're paying keeps on increasing, right? And it's getting further and further away from what the shorter term bonds are paying. This is a good thing. This is a sign of a healthy economy, just in general, not only real estate market, but a healthy economy. Now, the third and very last reason why the real estate market could crash, but probably won't, is the loosening of restrictions on mortgages. Okay. So we've seen this happen a little bit in the last 4 or 5 years. So we've seen a couple of people or a couple of banks and whatnot Fannie and Freddie start lowering their credit requirements. But again, guys, we are nowhere near where we were back in 2006, 2005, 2004, 2003, where we had those ninja loans, the Nina loans, where we had no income, no asset. I mean, we had loans that we can get somebody into a house one day out of bankruptcy, one day out of a car repo, one day out of literally losing everything, one day out of paying back a tax garnishment. All of those things we could do back then are just not possible today, thankfully. Right? So have we seen a little bit of a loosening on mortgages? Sure. But are we in a place where a 550 credit score or a 0 credit score, when the credit is just so bad, there's no score, can those guys get mortgages at this moment? No. And that's not a bad thing. I mean, I'm not trying to say that there are people that shouldn't have homes or mortgages, should I say, not homes, but mortgages. But we've got to make sure we're cognizant on a federal level of what that credit score and what that credit history looks like. Because if we're putting people into mortgages that cannot pay those mortgages, we're not having them prove income, we're not having them prove assets, we are just heading right back for that same disaster in 2007, 8, and 9 that we saw before. Thankfully, we are not heading in that direction. Yes, we've had a little bit of a loosen up on mortgages, but nowhere near what the wild, wild west looked like 15 years ago. Now, last thing, simply put, the number one reason why this real estate market is not headed for a crash anytime in the foreseeable future is the number one reason for pricing to go up or down on anything in this world is simple: supply and demand, right? And right now we've got the supply of buyers way up here. We've got the demand of buyers way up here. We've got the supply of sellers way down here. And there are a couple of reasons for this, right? And this is going to take a half a decade to a decade to fix and correct, to bring back to an equilibrium or to a buyer's market, right? And I mean, I'm talking like 5 to 10 years. And here are the two or three basic reasons why. First one, millennials are finally in the home buying market. And they've been in the home buying market for like 5 years at a low level, but they just finally looked at these interest rates, looked at the work from home situation, looked at how much they're paying in rents, because rents keep going up, and said, holy heck, I can go get a mortgage. I can save money. I have an asset that's appreciating in value. I'm paying down a loan. I've got a tax write-off. All of these things. Today's the day. Now's the time, right? Per the National Association of Realtors, in 2021, so far, 37% of home buyers are millennials. They are out there on the street. They're buying the properties. They're finally making those moves from either an apartment or the parents' house into their own home, which is fantastic. Second, we've got the Gen Xers. And a lot of these guys are now a work from home crowd, right? And being a work from home, you're spending a just immense number of hours in a home. And for a lot of people, they're homes they like, not homes they love. And again, they're looking at the interest rates. They're looking at the work from home situation. They're looking at all of these different situations and saying, hey, you know what? Today's the day. Now's the time. Let's make that move because I can afford more now than I could years ago, like 3 years ago, right? Because even though home prices are going up, interest rate has kept those homes extremely affordable on a monthly basis, which is so good. And then lastly, we've got people like my parents' generation, the boomer generation, where these guys have extremely slowed down on their moves, right? So in the several decades preceding the last recession, we saw people move an average of once every 7 years. That's not the case anymore. Now it's every 11, and for my parents' generation, it's actually 12. Right now, my parents are a great example. They built their home back in 2004. It's now 2021. That's 17 years at a home without making that move. Have they thought about it? Absolutely. Did they do it? No. And by not doing it, it was withholding a very small one house worth of inventory from the market. But the average has gone up to 12 years in a home, right? So that's almost 50% longer. Now, if people are staying in their homes 50% longer, that means they're not turning over as fast, which means we're seeing almost 50% less homes go to market. The second reason why demand versus supply is at a critical state right now is, again, just home building, right? And we started to see this in the news a little bit. So the numbers are out from the Census Bureau. In a typical decade, and I'm talking the last 4 decades before the Great Recession, right? We saw over 20 million homes built per year, right? And we saw it go all the way up to 27 million homes. From 2010 to 2020, we only saw 5.7 million homes. We're literally missing 20 million homes that don't exist. Now, I do believe in American ingenuity. I do believe in capitalism. I do believe in supply versus demand. I do believe we're going to kick the butts of the builders into gear. And frankly, they're trying to be in gear. You know, we're still running short on number of skilled trade and contractors. We're running short on things like lumber, which has been in the news because of those price hikes lately. But now those are starting to come back into equilibrium. I think that we could realistically see builders go from a typical 1 million homes built per year all the way up to a 2, maybe even 2.5 million homes built per year. But if that's the case, it's still going to take 5 to 10 years, depending on how many homes are built, how far we can push this thing. Still going to take 5 to 10 years to bring that back to where it used to be, right? And then another 5 years past that to make up the deficit for the homes that we don't have, that were never built. So we've got people waiting in their homes, waiting to bring them to the market because they're enjoying their homes or staying there longer. We've got 2 generations of people that are trying to buy their next properties or first properties. And then we've got home builders that built 20 million less homes in the next decade. So are there several reasons? Are there several red herrings to the economy right now and the market? Sure, absolutely. And I'm not going to dismiss any of that. There are some very smart people out there that are saying, hey, this one thing could take, like if you look at this one thing here that could go sideways, or this one thing here that also could go sideways, the real estate market can crash. But my opinion, this economy, we don't operate in silos, right? If the interest rate goes up a full point, will the real estate market crash? No. Will it still appreciate? Yes. Will it appreciate like it did last year? No. But that's it, because the economy does not operate in one silo versus another silo. It all works together. It would take much more than just any one of these 3 things to crash the economy. It would take at least 2 or more, and we're just not saying that. Not in the cards today. Thank you guys for tuning in. I appreciate you taking some time on a Sunday morning and checking me out. Again, should you have any questions, let me know. You can reach us at 248-886-4450. Don't forget, if you're watching YouTube, to subscribe. Hit the like button, hit the thumbs up button. Any questions, anything we can do, give us a call, shoot us an email, throw a comment in there, and make it a great day.